Episode 67. In 1967, the Pittsburgh Penguins entered the NHL. July 1st, 1867 is Canada's birthday, and 1966 to 67 were eerily similar to 2022 and 2023 when it came to what was happening in the world and what happened in the stock markets. 1966, there was war, inflation, and rising interest rates, only to be followed by the summer of 67, where the S&P 500 roared ahead 24%. Look at 2022. S&P 500 fell 19%, only to be followed by 24% returns in 2023. Beyond MD, episode 67, here we go! Hey everyone, thank you so much for joining me again on Beyond MD. Today's episode covers the topic of corporate shareholder agreements. So this will be relevant to anybody who has a corporation and is using that corporation to run a business or is using that corporation to invest alongside other investors. So to help me out on this topic, I have Parish Bhumgara. So a lot of you will know Parish from the Physician Financial Independence Group. He is a trusted and respected voice on that forum. Parish is an associate lawyer and member of the Business Law Group and Financial Services Group at Gardiner Roberts LLP. His practice focuses on general corporate and commercial matters, including mergers and acquisitions, asset sales and acquisitions, secured lending transactions, corporate finance, and corporate governance. Beyond work, Parish is passionate about mental health and personal finance. He founded a non-profit aimed at increasing awareness around mental health issues and volunteers as a board member for a registered charity that provides subsidized counseling services to people in London, Ontario. So guys, I hope you enjoy my conversation with Parish Bhumgara. Parish, welcome to Beyond MD. Thanks for making time for me, especially on a Sunday night. I know we're all busy, work weeks and weekends. It's great to have you here. And I have to say, I've been following you on PFI. I've seen some of your posts. Obviously you are insightful. You're really engaged. So I think this is going to be a real treat, but welcome to the show.
Yeah, thanks so much, Yatin. Pleasure to be here, and thanks for having me.
Awesome, man. So why don't you just kick us off by telling us a bit about yourself as a person and then professionally as well, so people can get a sense.
Sure. So I'm a corporate lawyer at Gardiner Roberts. It's a mid-sized Bay Street firm in Toronto. My fiance is a PGY3 in neurosurgery at Western in London, and so I split my time between the two cities. I did my undergrad and MA at Queen's in philosophy, and then I came to Western for law, and that's where I met my fiance.
So you are a corporate lawyer, and so I thought, today we're going to talk about shareholder agreements as they pertain to the corporation. So maybe let's just dive into it, and let's just start off with some basics then. So what is a corporate shareholder agreement, and then kind of what are the big picture scenarios in which one would need to consider this type of arrangement?
Sure. So at a very basic level, it's a contract between the shareholders of the corporation that can set out a number of different factors. So how they're going to govern their business relationship, how profits will be split, exit and transfer rights. So usually what we're talking about there, and I'm sure we'll get into it later, but death, disability, or divorce. Those are the three big ones that you want to make sure that the shareholder agreement specifies what happens in those particular situations. It's just basically a way of having certainty in your business dealings, right? The joke I like to make is it's like a prenup for a business.
Fair enough. But this may be a very basic question, but let's just say somebody opens up a corporation as a medical professional, and then they have one other shareholder, the spouse being in the corporation. That's a very simple setup, but is that even a scenario where one should take the time and set up a shareholder agreement? Or are we talking more about, okay, this is a corporation that is investing into something, say real estate, and there are multiple shareholders? Is that what we should be focusing on when it comes to shareholder agreements? I'm just curious right off the bat.
Yeah, no, so that's a great question. In the scenario where there's two physicians and they're both shareholders of an MPC, then it can be very like a married couple. Then it can be very beneficial to have a shareholder agreement, because in the event of divorce, it'll clearly spell out the rights and it'll just make the exit process a lot smoother. If it's the situation where there's a non-MD spouse and an MD spouse, the non-MD spouse has non-voting shares anyway, so there's no need in that situation. Definitely in the real estate scenario, any time you have a corporation that has multiple shareholders, and especially if they're third party to each other, like they're not known, or not like intimate family members, it can be very beneficial to have a shareholder agreement in place.
Okay, what about for family members? Because I know some people do invest with family members. Is there any type of arrangement that may be necessary there just to keep things really tidy and clean?
Yeah, so I think obviously I'm biased as a lawyer. We always want to draft the agreements. We always
Yeah.
want the business, right? But objectively, it is beneficial, right? It's the same way as a married couple would enter into or like couple about to get married would enter into a prenup. Um, when you're going to go into business with someone and potentially investing millions, or in our case, tens and hundreds of millions of dollars, you want to have very clear parameters on how your business relationship is going to work.
Another basic question. Is there any type of restriction in terms of who can enter into a shareholder agreement? Like, does it have to be individuals, or can it be other companies and corporations joining up with individuals? Any restrictions on that front?
No, so that's a great question, but there aren't any other than the obvious one if you have to be a shareholder of the corporation, right? But
Okay.
so if you had a situation where a holding company has invested in an operating company and the shareholder agreement is being drawn up for that operating company,
Mhm.
that holding company would definitely be a party to the shareholder agreement by all means.
So let's get into the meat of it. Let's talk about structure as it pertains to shareholder agreements. So let's just say you have a moderately complicated corporation where maybe you have a number of investors. Some of them maybe have voting rights, some of them don't have voting rights, and then maybe you even have like a board of directors. So when you consider an entity like that, maybe just use that as a springboard, or you can direct it in any way you choose. But what do we need to know about structure and then share types as it pertains to the shareholder agreement?
For sure. So generally speaking, when you're entering into a shareholder agreement, all the shareholders are going to have voting shares, right? Because that's part of the agreement is going to dictate how they're supposed to vote those shares in certain situations, depending on the scenario. Uh, Often, what you'll find is it depends on how much capital is being invested, right? So if you, me, and one other doctor are going to join together to invest in real estate, and I'm putting in 30% of the funds needed, you're putting in 30%, and the other doctor's putting in 40, the doctor's going to have they might have the right to put two directors on the board, and we might only have the right to put one director each, or
Mm-hmm.
something like that as an example.
Mm-hmm.
Um, but usually speaking, everyone's going to have voting rights. They might just be different classes of shares. So it might be class one commons, class two commons, class three commons, but they all have the identical rights and they're all allowed to vote. It's just the quantity of them might differ based on the capital investment that each party's bringing to the table.
But and then in terms of different, I guess, share types, what do we need to know about that? Because I know that when a physician will go ahead and even incorporate, sometimes that initial step of incorporating, it can be a little bit overwhelming to understand, well, what are the different share types? So when it comes to shareholder agreements, what do we need to know there?
For sure. So generally speaking, anytime you're incorporating a company, if you've done a good job, you're going to have somewhere between 8 to 10 classes of shares. A few of which will be voting shares. The rest will be special or preferred shares, depending on the lawyer's stylistic preference. But those shares are really just in place, down the line to maybe income split with family members, to give you flexibility with tax planning and stuff like that.
Hmm.
Usually, when we're talking about shareholder agreements, we're talking about the common voting shares that control the corporation, right? So
Okay.
the shareholder agreement, for the most part, is going to specify how those shares and the relationship between those shareholders is governed. Because when they're
Okay.
non-voting shareholders, they don't have a say in anything anyway, right? So they don't necessarily need to be a part of the agreement.
I'd like to take a minute to talk about a company that I've been following for a few years now. I initially met them on this very podcast and was taken by their story and passion to make life better for doctors. Introducing Aria Health, the groundbreaking electronic health records company that's redefining the way doctors practice medicine. Aria Health is all about putting doctors back in the driver's seat, in control of your destiny to become the doctor you've always aspired to be. Aria Health is not your typical EHR company. They're all about keeping the focus where it belongs, on you and your patients. They want to empower you to be caring, present, efficient, and powerful in your medical practice, without the burden of endless note-taking and paperwork. Join the ARIA Health community of doctors who are already taking back their lives and practicing medicine the way they were meant to, free of corporate shackles, one patient at a time. But that's not all. Your time is precious and you want to get back to what truly matters. ARIA's unique promise is to get you up and running as a new clinic in less than 30 days. And if you're thinking about integrations or migrations, don't worry. ARIA can get you set up in less than 2 months so you can seamlessly transition without missing a beat. What sets ARIA Health apart is their unwavering commitment to helping doctors thrive and making doctors the heroes of the healthcare story. They leverage the power of artificial intelligence, handling complex data ingestion and automating workflows so you can focus on patient care, not paperwork. And I've seen this in action myself. Visit ariaehr.com, that's ARYAEHR.com, and discover how ARIA can empower you to take charge of your medical practice. You can use a special code BeyondMD to get your first month for free. Okay, let's talk about maybe what type of key information needs to be outlined in the shareholder agreement. Because let's say you have a handful of investors who are a part of this agreement. I imagine you would need to outline things like what is the responsibility of each investor. Like I was about to embark on a partnership in real estate investing. Didn't go that way. But for example, sometimes you have one investor who puts most of the money down. Another investor may kind of manage the property. So I imagine you have to outline responsibilities. Maybe you have to talk about, okay, if we are going to add another investor into the mix, what's the protocol for that? If somebody needs to leave, what is the exit procedure? What happens to invested capital when somebody decides to leave the partnership? And then, how are payments made? These are some of the things that come to my mind, but maybe Parish, you can give us a quick overview on what are the types of things that really clearly need to be spelled out inside the shareholder agreement.
Okay, for sure. Yeah. So, I mean, you hit on all the major points for the most part, right? But definitely there would be a governance section. So things like how the board of directors is going to be composed, who's going to be on it. Usually, like we alluded to earlier, it lines up with the quantity of shares and an amount of investment. So if you have 3 minority investors worth 10% each only, and then another investor worth 70%, chances are that 70% investor is going to have the majority of the board control over the board.
Mm-hmm.
That being said, most shareholder agreements in those types of situations are unanimous shareholder agreements, which restrict the power of the directors to manage the affairs of the corporation anyway. Because in a usual situation, the directors would be the ones deciding when to issue dividends and making a lot of the types of decisions that are going to get delegated instead to the shareholders through the shareholder agreement. So governance is a big one.
Mm-hmm.
Another big part of that is shareholder approvals. So there's often a section for either fundamental decisions or certain very special decisions, such as amending the articles of incorporation, changing the type of business that the corporation is going to carry on, being able to take on a certain amount of debt, being able to lend a certain amount of money. These types of things there's usually a section which will say, you need 100% agreement to do any of those things. And so that's where it kind of gives you that certainty that that just because you're a minority shareholder, the majority one's not just going to go off and start lending the funds to his MPC or something, right? Or her MPC.
Right.
and misallocating the funds. Another related point is usually confidentiality and non-competition, right?
Mm-hmm.
You don't, especially if it's a novel business idea or something unique. We see this a lot with clinics. You don't want someone to just open up a clinic down the street from you after finding out, all the information they need. But by and far, the largest, or the most contestedly negotiated provisions are the share transfer ones. So what we mean by that is like exit rights, or in the event of a dispute, or death or disability, or divorce. So for example, if you and I are 50-50 partners in a business and you get divorced, and under that settlement, your wife is now going to get your shares. Well, I don't want to be in business with your wife. I've signed up to be in business with you, right? So there's usually a provision where, like, in the event of divorce, the corporation will just buy out your shares.
Okay.
And so you'll cease to be a shareholder at that time. usually the payout is structured over a certain amount of months or years, depending on the liquidity of the corporation.
Hmm.
So in terms of people do get their capital back if they're being bought out. It's just sometimes it might take a little while.
Okay.
On that, relatedly, there's usually a formula for determining the fair market value, or in some cases, depending on the value of the corporation, you might even have a chartered business valuator uh, evaluate the company to determine what's a fair purchase price.
So, Parish, I usually see these shareholder agreements happen for companies or corporations that are investing in real estate. Is that your experience as well? Or do you see these as part of the corporate structure even when there are other investments being made as well? Or is it mainly related to real estate? What is your
So,
experience?
so, so in our experience, it's usually any type of business, right? Real estate, generally speaking, at the higher levels is, and I'd love to have another interview with you on this, but that's partnership agreements. So where
Hmm.
there's usually like a general partner and then a bunch of
Hmm.
limited partner investors, and the general partner is the one in charge of developing and maintaining the property.
Yep.
But there it can be something as simple as when cannabis was booming, a lot of the time the cannabis clinics would be set up by teams or fellow investors, and so there'd be a shareholder agreement for that. Um, Pretty much any time a business is contemplating any kind of venture where there's multiple shareholders, there's usually a shareholder agreement in place.
Okay. Okay. You mentioned one term in there in that last answer. You talked about a unanimous shareholder agreement. Can you just quickly tell us, like, what is the key differentiating feature of that type of agreement? Because I just want to make sure I understand and the listeners do as well.
Sure. So usually under corporate law, the
Hmm.
way it works is shareholders own the corporation and
Hmm.
they elect the directors. Directors are the ones in charge of the management and supervision of the corporation. And then
Hmm.
the directors can appoint officers and delegate some, but not all of those duties to the officers. When you have a unanimous shareholder agreement, you're essentially taking power away from the directors or restricting their ability
Hmm.
to manage the affairs and instead giving it to the shareholders, if
Hmm.
that makes sense. So you can
Yeah.
have a
Yeah.
shareholders agreement
Yep.
without it being a unanimous one. But
Okay.
generally speaking, most of the
Okay.
time
I
they're
got it. That
unanimous
makes
because
sense.
you want to restrict them.
Maybe let's go over a few scenarios. And I think the first one, I'll maybe just ask you, maybe you have one off the top of your head, but sometimes when we're discussing a lot of jargon related to corporations, businesses, it could be really hard for somebody who's maybe thinking about starting something like this. It can be really difficult to understand, like, okay, why do I need a shareholder agreement? Like, what possibly could go wrong? And so I'm wondering, Parish, if you have any examples, obviously keeping things confidential, where a shareholder agreement was put in place and it really helped to resolve a dispute. Or maybe there's an example of a business where a shareholder agreement was not put in place and then things went south. Do you have any examples you can share just to like drive some of these points home?
For sure. So I think the most common one is anytime there's a 50-50 uh, split for a corporation,
Hmm.
the,
Hmm.
um, there's usually what's called a shotgun provision, which is like
Hmm.
it in the event of conflict, it allows for um, an exit basically. So what would happen is, say you and I are in business, and now for whatever reason I'm fed up of working with you, and I want to buy you out. I would make you an offer for your shares, and then you usually have 10 or 30 days to either accept that offer or counter that offer and offer to buy all my shares. So the reason it's called a shotgun is it's basically it's forcing the issue, right? One of us is going to buy out the other. It's just it depends on who has the capital to do that. But
Okay, gotcha. Okay.
shareholder agreements where we've had those in place have been great because usually whenever there's conflict, then one person can get out. Now they might contest the timing or sometimes that can cause other issues, but generally speaking, it's a lot cleaner than if there's not no agreement in place. Um, Another very common clause in shareholder agreements is that the parties agree to binding arbitration. So while that's still expensive, it's usually a lot quicker and a lot less time, less. It's still less expensive than going to court, right? So rather than spending 7 to 10 years in the Ontario civil court system, you can hopefully get the issue resolved through arbitration within a year or a little bit longer than that, possibly. But
Basic scenario here. Let's say that a physician is interested in investing in real estate. And this came up at a presentation that I recently gave. A lot of people were asking about this. But if you are wanting to invest in real estate, I imagine the conventional teaching for me at least has been that the corporation that is making the real estate investment should be separate from your operating company or your corporation generating the majority of your medical income, because let's face it, real estate investing can come with a different set of risks, and maybe best to kind of decouple those risks from whatever is happening in your operating company generating your medical income. Do you generally agree with that? Disagree? Because some people wonder, well, why do I need to open up a holding company or an investment company or another corporation? But what are your thoughts?
No, definitely if we're talking about an apartment building, Yatin, or any kind of real estate investment where your liability profile is increased, it's a
Hmm.
very good idea to have separate corporations, right?
Yeah.
Especially, I think I know in Ontario, the CPSO doesn't even like when doctors hold real estate through their MPCs, um, because then they can, if you get enough of those properties in your MPC, they can start to think that you're not just in the business of medicine anymore. You're also in the business of managing and investing in real estate, which is contrary to the bylaws and basically the laws that allow you to operate an MPC. Definitely a good idea to keep them separate. Um, if it's just one condo, you might almost be better off purchasing it in your personal name, but never through the MPC, either through a
Mm.
holdco or personally if you already have the funds available.
That's really interesting, Parish, that comment about what the college is okay with, because people have asked me this recently too, and my understanding is the same. They don't really like us to hold real estate through the medical professional corporation, but they're okay with us investing in more liquid assets like stocks, bonds, things like that. Is that your understanding too?
Correct. Yeah.
Let's talk about maybe liability. Like, let's say that you are a part of a corporation. There is a shareholder agreement in place, and you and the other investors put your money into an apartment building. You invest in an apartment building. Let's say something happens there. Let's say one of the tenants gets injured, or there's a fire, something happens. What can happen there? Like, what can let's say the tenants want to sue. What can they come after? What are the investors liable for? Maybe just take us through this scenario.
Sure. So absent fraud or some gross negligence, like the shareholders burning the apartment building down for the insurance money or something like that,
Hmm.
the by incorporating and having that corporate shield, their personal assets will not be at risk, right? The
Hmm.
corporation can get sued, and the corporation's assets, which in this case would likely be the apartment building and maybe
Hmm.
any retained earnings or other investments it's made, those would all be up for grabs to settle a, a judgment creditor's claim. But the personal assets of the investors are not going to be available.
Okay. So let's say I am investor A in this venture, and let's say I put in $200,000 towards this apartment building. So that's pretty much what's at risk, and they can't really come after anything beyond that. Is that what I'm getting from this?
Correct. Yes. Again, like
Okay.
with the usual lawyer language, like absent fraud or any like suspicious circumstances, yes. The
Yeah.
only
Yeah.
thing you'd lose is the 200K.
So maybe just some basic housekeeping things now, like in terms of setting up a corporate shareholder agreement. It seems like there are a lot of advantages, but are there any potential disadvantages to this type of structure? Apart,
So
I'm assuming more complex, but anything worth knowing?
honestly, the biggest disadvantage is sometimes, or the reason we see people not doing it is cost
Mm-hmm.
and the added layer of a little bit of complexity, right? Because usually what'll happen, definitely if it's a 50-50 split, each side will usually have lawyers um, to review the agreements with them or negotiate them. And so then that can, sometimes delay the business hitting the ground running. Um, but really the biggest disadvantage I can think of is sometimes cost, right? Otherwise,
Okay.
in my mind, there's no reason not to have one anytime you're engaging in a corporation with multiple shareholders and starting a business.
I know we tend to rely on our accountants for a lot of things, but I'm assuming that this is one of those things you probably don't go to your accountant for. Or if it's real estate oriented, I imagine this is probably something that real estate lawyers also don't deal with. It's a corporate lawyer, correct?
Yeah, for the most part, that is correct. At a full service firm like ours, though, our real commercial real estate lawyers do often see them, but they'll usually
Mm-hmm.
they'll get us to draft them in consultation with their clients, and their input based on what they know about the deal and stuff like that. But yes, usually speaking, for the actual drafting of the contract, it would be a corporate lawyer.
And then in terms of cost, I imagine there's a great deal of variation in terms of how complex the setup is. But can you give us some ballpark figures for, let's say, there's a small joint venture, maybe 2 or 3 physicians inside a corporation wanting to invest in real estate, and then maybe a much more complicated company structure with different tiers of investors and a board of directors. Can you give us an idea of what the costs are to set this stuff up?
Sure. So as a rough ballpark, on the smaller scale, like the couple physicians investing in real estate, like you mentioned, maybe $5,000 to $15,000 would be a reasonable estimate, depending on how much the other lawyers negotiate, if that makes sense. Like 5 on the low side, if the first draft of the agreement basically goes through without everyone nitpicking it to bits, then maybe it's closer to the 5-10K range. But if it starts getting, protracted negotiations and like the parties are kind of drifting apart, then it can easily go into that 15 to 20 range. On something more complex, it depends on the size of the fund and the number of shareholders and the size of the investments, really. But we've seen anything from, on the low end, maybe 30 grand to upwards of 100.
Wow, interesting. Hey, honestly, even for like the group of doctors going into real estate and setting this all up, I didn't know that. But that's helpful to know. Are these fairly quick to set up? Does it take time? Like, what can we expect there?
Depends on the lawyer, depends on the parties. I'd say about budget at least about a month,
Okay.
to get them from start to finish. It's hard to say because it really depends on the other lawyers involved as well, right? Like if you hired me and I did a first draft, but then the other lawyer just rejects that draft entirely and comes back with their own, and then obviously that's gonna set us back,
Yeah.
right? But if most of the time we're reasonable, and so I would say about a month or two at the most.
Parish, is there anything that we have kind of missed on? Any information that we haven't touched on when it comes to shareholder agreements that you think is worth knowing for our listeners?
Sure. So I think some of the transfer provisions I just kind of glossed over. Um, if you want, I can run through a couple common ones real quick.
Yeah, please. Yeah.
Okay. So usually all of these agreements will usually restrict the right of shareholders to transfer their shares because of that whole element of wanting certainty in your business dealings, right?
Mm-hmm.
That being said, in certain situations, you want to allow people to transfer their shares. So if, for example, a neutral third party came and made an offer on your shares,
Mm-hmm.
then, and let's say you were the majority shareholder in this case,
Mm-hmm.
you might want to have what are called drag along rights. So if it's a good offer and you want to sell, then you want to be able to force the other minority shareholders to also come along with you for your offer. So you want to drag them along.
Interesting. Okay.
On the opposite side, as a minority shareholder, you might want to have what are called tag along rights. So similarly, if an offer comes to the majority shareholder, which in this case is you, Yatin, then I would want to be able to piggyback on that offer, right? And so if someone's buying you out, then they also got to buy me out.
Okay.
We could keep going, but I think for tonight that's good enough.
Okay, maybe we can hold on to the other stuff for maybe another interview. But Parish, is there anything else that because I've seen you post some really insightful things on PFI, as it pertains to corporations, corporate structure. But I always give my guests like a chance. If there's anything else that they do want to share, please feel free as we wrap things up.
I would just say if you're contemplating any serious kind of business venture, invest in a shareholder agreement. It's well worth it, and it's just there's no reason not to, really, because the cost is deductible to the corporation anyway.
Yeah, that's a good point that I didn't ask you about. Thanks for that. Parish, listen, thank you for making the time for us. And, I know some of these topics on the surface, they're obviously not as exciting as investing in the markets, but like this is why I have this podcast. It's to cover all the other stuff that we do need to get exposed to. So again, I want to thank you for your time.
No, thank you so much for having me. I really, really appreciate it.
Okay, there you go. For anybody with a corporation, hopefully some useful tidbits in there with the interview with Parish Bhumgara. Thank you so much, as usual, everyone, for joining and supporting the show. There's a lot going on right now, and I'm working on a few projects that I hopefully will be able to share with you guys in the near future. But I think what this is going to do is, I was going every 2 weeks with the podcast. I'm definitely going to have to push that to every 3 weeks. I will try my very best for an episode every 3 weeks. We do have some really interesting interviews coming up, so I am excited to share it all with you. Reach out anytime, links below in the show notes, and until next time, stay well, stay savvy.